Welcome to Thoughts on the Market. I'm Michael Zezas, Head of Public Policy Research and Municipal Strategy for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the intersection between U.S. public policy and financial markets. It's Wednesday, March 25th at 11 a.m. Eastern. Congressional leaders today announced a record-breaking level of fiscal stimulus and aid to deal with the crisis caused by the coronavirus. Details are still forthcoming and could change, but here's what we think we know. At roughly $2 trillion, or about 10% of U.S. GDP, the bill would provide direct cash payments to taxpayers, extended unemployment benefits, a boost to Medicaid, forgivable loans to small businesses, direct aid to municipalities and hospitals, and loans to larger companies that are acutely affected by the reaction to the spread of COVID-19. Simply put, there's a lot going on in this bill that aims to help all Americans with social, economic, and health issues. And so it's fair to say that whether or not it works is going to be a judgment across all those lines. From the very narrow perspective of its impact on the economy, it certainly doesn't fix everything, but we do think it will help make sure the coming sharp U.S. recession won't be a prolonged one. Remember our two-pronged test for sufficient stimulus. First, does it substantially limit the risk that people and businesses will run out of cash because of the virus? We think it does. Small business loans are sizable and forgivable if businesses don't lay off employees. Loans to larger affected companies are available too, albeit with conditions on stock buybacks and executive compensation. And for individuals, the bill would send checks to most Americans and expand unemployment coverage. The second test was, does it build faith in a quicker economic recovery? We think it does. It's likely a record-breaking stimulus number. Additionally, there are some provisions that, if they remain in, could help heal credit markets, which is important to ensuring that a liquidity crunch doesn't become a credit crisis. If you've been following markets, like the muni market, you know that investors' rush for cash as COVID fears spiked led to significant problems in the operation of fixed income markets. Aggressive work by the Fed to pump in liquidity appears to have started the healing process in the Treasury market. Yet credit markets need their function to return to normal so that payrolls can be met and capital spending can resume. This bill attempts to help by providing a pool of money that the Treasury can use to fund Fed operations in the credit markets. When we get final bill text, we'll be watching carefully to see if that provision stayed in. And of course, if the bill changes meaningfully and changes our view, we'll be back to tell you that too. Thanks for listening. For more video from Morgan Stanley, please subscribe here to our YouTube channel, or you can subscribe to Thoughts on the Market directly on Apple Podcasts or your favorite podcast platform.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.